What is network effect in investing, and how does it relate to racial inequality? Today on Off the Sidelines. Hey everyone, this is Off the Sidelines, an investor education series from us here at Technically. I'm joined today by Nasir Qadree, the founder and managing partner of Zeo Capital Partners. Nasir, how are you today?
Stephen, it's great to see you.
Thank you so much for joining us.
Glad to be here. Glad to be in an important conversation in these unprecedented times. But thank you so much for having this conversation and again for having me.
Absolutely. So we wanted to get started with the background on Zeal Capital Partners. So could you tell us a little bit about the journey to launching the firm?
Sure. So, Zeal is a, just literally building on top of my life's work, particularly over the past 7 years, investing, sourcing, investing and helping scale early stage companies. Unifying themes have been that these are companies that traditionally don't get institutional capital but they're investable companies. So started my investment career in the private sector at Goldman Sachs and in State Street Bank and traditional financial services, and then ventured over into civic work, working with Cory Booker, and then as an appointed official in Connecticut at the Connecticut State Department of Education, leading the state's digital learning and infrastructure strategy. And then, I got my foray into, after friends and I, we owned a coffee shop. And it was essentially a WeWork that meets a coffee shop. And we attracted a lot of social entrepreneurs in New York City, by the way. And it was fascinating. We attracted also a lot of venture capitalists, and that's when I got my foray into venture capital, into the private equity space, and then later moved to DC and joined Village Capital, where I was global head of education, where you and I met actually. You and I met maybe five years ago now. And then served as the U.S. Economic Opportunity Lead, and then later led AT&T's, most recently led AT&T's Social Investment Fund. But for me, I knew that it was the way we thought about access to capital in the private markets was we had to democratize it. We have to democratize entrepreneurship, and also we realized that there was a lot of innovation happening into the sectors in which I was investing in education technology, employment technology, human capital management, people operations. So the future of work sector, and then couple that with financial technology and health innovations. And so I knew, as I began to see a lot of innovation happening across these verticals, all across the country, not just very few places, backing the same people, coming from 5 different schools on average in terms of where they graduate from. I thought, I started really giving a lot of thought based on my track record, the reputation I was able to build, as well as just overall domain expertise across these two sectors, that it was time to launch a new vehicle. And so far, so far so good. The response has been excellent. The response has been amazing. We're based here in Washington, D.C., and I'm excited to get started.
Great. It's really interesting to learn about the firm and where you're going, and right there based in DC, which is right in Technically's coverage area. So let's dig in here. In investing, what is network effect when we talk about investing, and how does it relate to racial inequality?
Yeah, so let me just first and just share the crux of Zeo, by the way, the crux of Zeo Capital Partners. So we, as you mentioned, we're headquartered here in Washington, D.C. Our focus is partnering with exceptional, diverse management teams that are building early stage, high growth, tech enabled businesses focusing on bridging our country's wealth and skills gap that we believe turbocharges economic mobility across the country. We do that by investing in two verticals, A, being the financial technology sector, and B, being the future of work sector. Now, this was a pre-COVID, pre-social unrest pandemic, investment strategy. And coincidentally, these are also two areas, when we think about income inequality, wealth, and skills, is the 40 million plus workers who are unemployed, who are at home trying to continue to reevaluate their make sure they're competitive in today's workforce. And coincidentally also, these are also two verticals that have disproportionately impacted the Black community, particularly low wealth communities. And so when I think about the network effect in investing, to your question, it's really understanding if you think about it from a supply and demand in our economics, macroeconomics days, right? The demand being the problems that are happening in society, and that's, from an investing perspective, right? And then from a supply being the entrepreneurs who are building sustainable businesses, high growth businesses that are solving problems, that are building solutions to solve these problems. And, I think, if you want to have a strong network effect, it's important that your team, your investment team, is diverse, right? You have a team who knows how to tap into these markets where these entrepreneurs are building businesses. But then there's, on the other side, you're looking to scale these solutions into low wealth, under-resourced communities. And so I think it's being proactive and intentional about your team, but also having a strong understanding on how to proactively engage with the entrepreneur in efforts to help him or her scale to the right consumer, to the right communities, to the right families, depending on the product. And your hope, as our hope at Zeal, is that we're an exemplar. We're an exemplar to show across all VC, venture capital firms, private equity firms in general. This is what happens when you build a team that is diverse from gender, diverse in ethnicity, diverse in background, and just an upbringing, and then you just automatically over-index your allocation in networks, in people, and that they usually don't get the type of investment, resources, and mentorship.
So one aspect of kind of how investment has worked for early stage companies, we know that the warm intro can be is almost a form of currency in itself. But so is it inevitable, or is it toxic?
Let's have a conversation there. Let me push it back to you first, and then what are you hearing the most, and how do you think about that?
I think when we're talking about the warm intro, we know that it relates directly back to what you're hearing with what you were saying with network effects, that I can, go out and essentially if I know someone who I'm going to go vouch for, then I'm going to make that introduction, and that's almost the way that, investors will, that's the way the pipeline is built essentially, right? But I think the question that we're really coming to as we start to think about, how we're going to expand networks and how we're going to and how we are going to go out and be inclusive about the way we invest in all types of companies from all types of backgrounds. So is that the way that this has to be, the way that these connections have to be made, and the way it has to be structured? Are we always going to get back to that, or ultimately, are we feeling like that part of what's kind of build the system the way it is, where there are these blind spots? But
that's where I'm touching on next, Stephen, is that recognizing our blind spots, right? If we're going to change our pipeline, change the way where we invest, how we invest, we have to check our blind spots, and that's been the system, the structure over the past 50 plus years in the private equity markets. And I think warm introductions will continue to be helpful for entrepreneurs, but I also believe that it will continue to be toxic if investors, my peers, continue to invest based on pattern recognition. I mean, less about what they're investing in, but more about taking bets on founders who may just be betting on them because they went to their alma mater, or they're part of their or just say, let's just use alma mater for example. I think that's wrong. But I also think that even I have blind spots, right? I went to a historically Black college university. One can argue that my network is only historically Black college or founders who come from historically Black college universities. But humility aside, I have proactively really developed a cosmopolitan network that's allowed me to have a differentiated, diverse pipeline of founders. And so I don't think we were doing the best job at earmarking our traveling dollars or our networks to ecosystems where traditionally doesn't fall within their networks. And the truth is, if we really want to tell the story of America's innovation, we're better off telling, sharing these stories that's coming from all across the country, from rural and urban America, from whether you went to an Ivy League school or HBCU or any other or 2-year school, a trade school, and really capturing the breadth of innovation across our country. Unfortunately, today, as you know, it does not reflect that. Where 80% of capital has gone to 3 places: Boston, Silicon Valley, and New York, while the 47 other states, including DC, are fighting over the remaining 20% of capital. There's been a 55% reduction rate and growing since 1995 in states outside of those 3 states as well. And so I just think there's this on the one hand, there's a clear missing opportunity that we're not proactively and intentionally looking to invest in other places. The good news is that now more than ever, we're seeing a lot of that happening. You have Steve Case's Rise of Rest Fund, and coincidentally, we're both here in DC. So I think there's funds like ours who are walking the talk, and again, I think investors in these larger ecosystems, these large tech ecosystems, will listen when there are companies who come out of these ecosystems, right? So when companies, particularly unicorn companies, come from Detroit, DC, Atlanta, Iowa, Denver, then I'm sure they'll begin to take more notice, because what happens is that it's clear that there's enough resources that's allowing these companies that are headquartered in these second tier cities thrive and actually become billion-dollar enterprises. And I'm optimistic that there are a lot of companies who are headquartered in those cities, secondary markets, who will become unicorns. And a lot of that has to do with just being capital efficient, and capital just going much farther versus being in more expensive cities.
Yeah, and I, as we are in this year of 2020, when we have pandemic, when we have social justice call, when we have, these things that are waking us up in certain ways, we have the pandemic that's making it evident that, remote work and being able to do business from anywhere. We always knew that was true, but now it's at the front of everyone's mind, right? And we have, places that are, and we have businesses, we're making calls to Black Lives Matter, but now but there's been a recommitment, right, after the events in June with George Floyd's death and series of deaths at the hands of police. So so when you're thinking about taking some of that work forward and carrying forward, why is racial equity something that all investors should incorporate in their work? Why do you think it's important for investors to incorporate racial equity in their work, and how?
Yeah. So it's incredibly important to recognize the genius in Black people. I'm just going to bluntly say it and not be apologetic about it. I mean, genius is everywhere, and there is a missing opportunity when we don't proactively invest in innovation that's led by Black people. And I think that, that's the way the structure of private markets and venture capital more specifically has been built. It's been built in a way that has not afforded Black entrepreneurs the ability to have capital and realize their business's full potential, right? And so Morgan Stanley put out a paper a couple of years ago that essentially said, on the one hand, when we don't invest in women and people of color, it's a missing opportunity. It's a $4.4 trillion missing opportunity when we're not investing in women and people of color. And when you think about the assets under management here in the U.S., the 70 trillion, close to 70 trillion assets under management, only 1.3 look like myself and women. So that's managed by people of color and women. Mm-hmm. And then we know that when you invest in Black women and just diverse founders in general, you do outperform. When you have a diverse management team, you outperform. And so there's these clear metrics that clearly show that, when you look at when you're sourcing companies with a racial equity lens, right, you will it's a good chance that your portfolio will outperform as well. And so it's for the investor's benefit to proactively invest in companies with a racial equity lens if he or she is looking to have an outperforming fund. But I think it goes back to, again, the network effects, right? If you're going to have an investment strategy that that invest in companies with a racial equity lens, and you expect to have a network effect as it relates to your ability to source these companies all across the country, then it's important that you incorporate that in your mandate. You incorporate your pledge, or so. I mean that's another question, right? Like, how do you hold funds accountable to ensure that they're betting on Black people, that they're betting on Black entrepreneurs and women? And we've done things such as we created a pledge, right? And so for every company that we invest in has to be either current or potential. So most of the companies, just given the way our networks and the way we're structured as a firm, we will be investing mostly in women and people of color. But even if you're not, if you're an all-white Stanford grad, we'll still look to invest in you, just given that you coincide with two of our sectors. But we have operating partners we have Rachel Williams, who was former D&I at StubHub. We have operators who spent time in the future of work in fintech space. So helping you think thoughtfully about your recruiting and your talent strategy. And so I think that's also the case. It's like, making sure when you think about post-investment value creation, once you invest in a company and you think about your value add to that company, not just sitting on his or her board or providing introductions, but also just having systems in place that will allow this founder to really beef up other areas like recruiting and sales and product and technology, for example. But particularly the recruiting, the talent is important as we think about increasing teams, diverse teams that are diverse in gender and ethnicity, but we do that because we know that when we do that, the teams the fund more than likely will outperform, just given having diverse perspectives. But I think again, investing with a racial equity lens, it benefits the power of just showing the breadth of innovation across our country, and it's a missing opportunity or missing narrative and missing investment opportunity when we don't do that, when we don't proactively with intentionality seek those founders who deserve capital.
Love that. Yeah, I think another thing that we've often heard and would love to get your insight here as the idea of venture capital and kind of certain behaviors and norms that are associated with that. So as a last question here, is there anything that we might be accustomed to seeing that you would like to see change? In venture capital, what behaviors do you most want to see change?
That's a great question. My team and I, we talk a lot about transparency, right? I think too often in the private markets and private equity, venture capital, particularly early stage investing, entrepreneurs are forced to be incredibly transparent, way more, unfortunately, than the investor. And at Zeal, we stress to founders we talk to every day that we want you to conduct diligence on us just as much as we're conducting diligence on you, because the truth is this is a long-term relationship. And so, it's part of building that culture, right? This is what I'm most excited about with Zeal, is that we are building a culture that is entrepreneurial friendly, that we want them to ensure that they are understanding the breadth of resources that come when they partner with us. And our goal is to help them realize their company's full potential, and of course, add as much resources as we can to get their company to that billion-dollar enterprise, take it IPO, M&A, whatever the exit strategy may be, depending on the company. But the more investors are, we're better off when investors are more transparent versus entrepreneurs being too transparent. I think that's one. I think another is in the uproar of George Floyd, Breonna Taylor, James Blake, and hundreds of thousands of other Black people being slayed by the hands of police officers. I also think we are going to understand each other better. I think we're going to see a community of an investment community who will expand their dinner tables, who will really lean into these other markets where Black entrepreneurs are thriving, here in Washington, D.C., in our backyard, Stephen, in Atlanta, in Detroit, in Chicago, and just see all the amazing innovations that's happening in these ecosystems, and take bets. While to my earlier point, while there might not be a unicorn company that we can highlight directly. For us, it was AOL, Living Social. That's been a long time ago. We need the next AOL in our own backyard. So I do see investors really leaning into backing more diverse founders and fund managers as well. I think backing diverse fund managers is also, which I'd argue, an even more critical component of making change, because the truth is, diverse fund managers who have a closer network and a differentiated sourcing strategy than your traditional investor can really yield positive impact in providing capital to women and people of color, versus maybe a traditional investor who's done well in Silicon Valley, but unfortunately doesn't have that sourcing capability to source Black founders across the country.
Say a little bit more about that, the role of fund managers and what their space really is within this conversation.
Yeah, so fund managers or GPs, general partners, which is what I am. We go out and we seek capital from LPs, limited partners. We call that the money behind the money. That's private foundations, endowments, family offices, high net worth individuals, sovereign wealth funds to some extent, and university endowments. And these are accredited investors, entities that have a particular mandate to increase their portfolio, whether it's their clients or the universities or the pension plans, for retired employees, for example. And they bet on venture capital, the private markets, to go out and make smart bets into entrepreneurs and companies that could possibly be the next unicorn and return 10x the capital in which they initially invested. So the role that the GP has is these unique investment strategies, coupled with their ear to innovation. And when you think about who there's when you think about going back to where the managers the GPs who are managing capital, of that $70 trillion that the LPs have deployed to GPs, only 1.3 is managed by people of color. So that's the disparity I was getting at around. You have this huge gap of capital allocation, but only 1.3 of that 1.3 is only managed by women, people of color, and then going back to the 4.4 trillion that's left on the table when we don't invest in women and people of color. So when diverse GPs, diverse managers have unique, again, sourcing capabilities, they have unique networks, they have domain expertise after spending years maybe in investing in companies in that sector over time, or being an operator over the years. And so it's not just investing in diverse managers because they're a person of color, but they're also credible. They may have a track record. They have diverse, different networks. They have domain expertise. They have investment experience. And so that's my other hope to your question, right? Is the change in how LPs allocate to GPs, which we're seeing a lot, because you're seeing one proactive approach that a lot of corporations and vehicles are playing is to really understand where are the diverse diverse managers that have a specific mandate to invest in underrepresented entrepreneurs.
Great. This has been so educational and just really, the illustration of not only, how you came to launch Zeal, but also digging into the behaviors and the disparities, frankly, that exist and the work we can do to overcome those. So thank you so much for joining us, Nasir. Where can folks find you?
Well, first, Stephen, thank you for having this conversation. We're still in the middle of this social unrest, and I don't think it's going to let up anytime soon. We're approaching the election. That's a larger call to action. And so I just thank you and a number of other platforms that are having these tough conversations with thought leaders across the investment community, the tech ecosystem, and more broadly. And I'm excited that there's a new investment vehicle here in our own backyard, being Zeal, that's going to proactively source and invest and help scale companies that are bridging our country's wealth and skills gap. You can find me on my first and last name on all social platforms, NasirQadree, and you can email me anytime at nasir@zealvc.co.
Perfect. All right. Well, this has been Off the Sidelines. Thanks to Nasir, and see you all next time.